Right here is a chart of the U.S. 10-year yield. Now look at this, folks. This is a target that I gave you guys just yesterday. We talked about this target price up here. Bear with me as I got some lines on the screen. Right there, that is your upside target, 4.6%. Look at how close we got. We are seeing yields beginning to reverse. Now, it's important to understand what's going on here, folks. You now have 700 banks with more real estate exposure on the commercial side than is recommended, meaning they are over leveraged. The fact that rates continue to go up means these banks are going to get more and more stressed. In my opinion, you're going to see more bank failures. It's almost inevitable. So again, rates up here is, again, a good thing to control inflation, but there are things in the underworkings of the economy that are not built for rates to be this high anymore. And that's where you get breakages. That's where you get black swan events. So always remember that. It's not that rates shouldn't be up here. Honestly, they probably should. But again, when you have a system built on a house of cards with a government that spends money left and right without any checks and balances, when the private sector has just continued to spend money as well, building up massive, massive debts, consumers, trillion-plus-dollar debts, mortgage rates, all of these things. This is where you get breaks and why I continue. And I've said this, listen, since the markets were at their recent 52-week highs, I have come to you and I have said you have to be careful in this market. And it does not change here. If, in fact, with rates higher, you have to be even more careful. All right, so what I see on this chart here, I put in the RSI. This is RSI. I use it for divergences. I want to teach you a little bit about that today. So what I want to show you here is take a look at how you have a trend line right here, right? So a trend line also giving us resistance right around this level up here. And then look at the RSI. Basically, the RSI has flatlined. To me, that is telling me there's a divergence here in the RSI, and it is a negative divergence. In theory, the RSI should have the same upside move like this as yields are having. It does not. That, again, is telling me that you're getting ready for a pullback in yield. So, again, I don't use RSI, and I want to be clear on this. You know, RSI above 70 is considered overbought. Under 30 is oversold. That should mean nothing to you. I have seen charts that have stayed below 30 for months at a time and gone lower. It's the divergences that are a factor in your analysis. Okay, so very clearly, what are we talking about here on the chart of the 10-year? I expect the 10-year, maybe it touches 4.6% or not, but either way, it got within about 0.04%. And my expectation is a retrace down to this level here. So you're looking for it to come back to about 4.35%. Now the question is, will that give the market a bid? Normally I would say yes, but I wonder what is happening. I get the sense that under the underlying economy, things are starting to crumble. I wouldn't be surprised if we hear about bank failures over the next couple days, or maybe the Federal Reserve is going in already and kind of cushioning the blows here to help save them. How many banks are too big to fail? We don't know at this point, but I'm telling you right now, banks were not in a position to assume rates were going to go above 4.5% on the 10-year. And there are banks that are literally walking zombie banks out there. And that, again, whether the Fed and the government bail them out, I don't know. But I do know that, again, if not, you have trillions of dollars that literally can go into default. And listen, we're not even talking about the refinances. Some of these banks have literally in the next couple of years $1.5 trillion they need to refinance at crazy higher rates than what they had right now.